Michael Burry has just sold over $70 million of his US stock holdings. He has been selling during one of the strongest US stock market rallies in history, which is reminding many of his behavior in the lead up to the financial crisis. This is one of the few investors who saw the 2008 crash coming and benefited immensely from it. His trade allowed him to personally profit around $100 million and earn more than $700 million for his investors when the stock market crashed by about 60% within months. Recently, Burry has found himself back in the spotlight. He's been offloading much of his US stock holdings, signaling a pretty pessimistic view on the American stock market. And he's added a few very interesting trades to his portfolio instead that we'll be looking at today. First, it's important to note that we can follow Burry's portfolio moves based on his mandatory 13F filings. These filings aren't real-time updates, but instead reflect data from the previous quarter. This is important to note as the information in these filings could be expired and shouldn't be relied on 100%. That said, they still give a pretty clear sense of Burry's strategy. He is significantly cutting his exposure to US stocks while increasing his position size in the Chinese market. In the last two filings, Burry has completely sold out of 14 different US stocks, a move that represented over $70 million. Earlier in 2024, he had also unloaded all his positions in major US tech companies like Amazon and Alphabet. So far, it doesn't seem like this was a great decision, as these two companies have been some of the best performing US stocks in 2024, right up until the fourth quarter. So why is Michael Burry aggressively pulling out of such strong performers today? Well, Burry is not afraid of going against the crowd and leaving money on the table when he believes things are getting too risky. This is exactly why so many investors follow him. And right now, the valuations of US companies have risen to concerning levels. Take this chart of the S&P 500's PE ratio, for instance. It shows us how expensive the US stock market is at any given point in time. The last time the S&P 500 was this expensive was in the late 1990s. In hindsight, we know that period to be the peak of the internet bubble. And when the bubble burst in the early 2000s, investors who were heavily invested in those overvalued stocks suffered painful losses. The only other time it was this expensive was briefly in 2021 following the pandemic, when there were massive rounds of stimulus that were distributed and interest rates were near 0%. Michael Burry may be seeing this as a poor risk reward. Or in other words, he thinks that US stocks may have limited upside potential from here, but a lot of potential downside risk. But it's not just high valuations that are concerning about today's US stock market. There's also something called high concentration. This happens when a small number of companies dominate an index. Today, 25% of the S&P 500, the main US market index, is made up of four companies: Amazon, Microsoft, Nvidia, and Apple. So basically, a large portion of the S&P 500's performance is driven by a handful of very expensive stocks. Not the most reassuring setup. High market concentration is like a table with just one or two legs holding it up. As long as those legs stay strong, the table stands. But if one leg breaks, the whole table can collapse. A well-balanced table with many legs is much more stable, just like a well-diversified market with many strong stocks is more stable. And when we look at market concentration over time, we see that we are at one of the most severe levels of the last 30 years. This level of concentration is significantly higher than what we saw during the peak of the dot-com bubble in 2000. Back here, a handful of names such as Cisco, GE, Intel, Exxon, Oracle, and IBM made up a significant portion of the S&P 500's market cap. A few large expensive stocks made up a large portion of the index. Today, we have the same phenomenon, but to a greater degree. But it's important to remember that market concentration, or even valuations for that matter, are not efficient market timing signals. Stocks can stay overvalued for an extended period of time, and market concentration can stay at elevated levels for a long time too. Michael Burry very likely knows this, but still does not want to be taking the risks associated with these market conditions. But the question now is, what is he buying instead? Well, in the third quarter of 2024, Burry made a substantial shift towards three major Chinese tech companies. He increased his stake in Alibaba by nearly 29%, bringing the total valuation of that position to $21 million. He doubled down on JD, increasing his holdings to $20 million. And he significantly upped his stake in Baidu, growing it by 67% to about $13 million. Altogether, these three investments add up to nearly $55 million, which accounts for 1/3 of Burry's entire portfolio. Part of the reason behind Burry's big China trade likely lies in low Chinese valuations. China's stock market PE ratio right now is at only 10.2. The PE ratio is a way to measure how expensive an index or stock is. Right now, China's PE ratio is at one of the lowest levels seen since 1996. Despite historically low valuations, investors are still very pessimistic towards Chinese stocks. This makes China a polar opposite trade to US tech. Today, China's stocks have low valuation risk, but high reward if things do turn around. So, what could potentially catalyze a turnaround in China? Well, for context, China's economy has been struggling with poor growth, a troubled real estate sector, and weak consumer demand. In fact, China's consumer confidence is at record levels since the 1990s. If people are not confident on the economy, then they are more likely to save rather than spend, which can lead to declining economic growth. This has caused the Chinese stock market to decline by more than 60% between 2021 and early 2024. To combat these issues, the Chinese government announced multiple rounds of stimulus in 2024. For example, in January 2024, China's central bank cut the reserve ratio requirement by 0.6%, injecting around $140 billion to support economic activity. That caused this short-term rally in the Chinese stock market here, but it eventually gave back most of the gains. Then, in September 2024, the Chinese central bank announced interest rate cuts, mortgage rate reduction, and an equity market support plan of about $110 billion. These stimulus measures resulted in an instant 50% rise in the Chinese stock market. More recently, in October of 2024, China announced a $1.4 trillion package that will be spread over the next 5 years, and with the possibility of even more to come. Some have called this effort the bazooka stimulus because of its massive size. This signals the Chinese government's commitment to economic growth at almost any cost. These waves of stimulus are expected to have a significant impact on Chinese consumers. Data shows that Chinese disposable income, which is basically the money people have left after paying their taxes and essential expenses, is projected to grow rapidly over the next few years. After stagnating for the past 3 years, disposable income in China has finally picked up in 2024 and is now expected to increase by 50% in the next 5 years. This surge in consumer spending power could provide a major revenue boost for companies like Alibaba, JD, and Baidu. Burry seems to be anticipating that these stimulus measures will eventually kick in and fuel growth for China's biggest tech firms. If that happens, the potential upside for these companies could be enormous. However, the road to recovery is far from guaranteed, and Burry seems to be well aware of the risks. In fact, in the third quarter of 2024, he has hedged his positions on the Chinese market with put options. Think of put options as a kind of insurance against short-term downside on stocks. If Chinese stocks go down, the value of his put options will appreciate. Essentially, Burry is insuring himself against the very stocks he's buying. For Alibaba, Burry bought put options covering about 169,000 shares, valued at around $18 million. For JD, he hedged his entire position with puts on 500,000 shares. And for Baidu, he purchased puts on roughly 83,000 shares, valued at $8.8 million. Together, these hedges total $43.6 million. So remember that $55 million China trade from earlier? Well, this ensures almost 80% of that trade. His new put options on Chinese stocks suggest that he was perhaps getting uneasy on short-term downside risks that he wanted to hedge against without necessarily dumping all of his positions. This is a common practice on Wall Street and often an efficient strategy. Michael Burry was perhaps already preparing for Trump's presidency being a short-term risk to Chinese stocks, given the US-China trade disputes. In fact, Chinese stocks haven't performed too well since Trump's win here. Trump has a conflictual relationship with China when it comes to trade, so it's difficult to say whether the impact will be short-term, in which case the weakness could already be behind us, or whether it will have lasting negative effects on the Chinese stock market. Burry's strategy appears to be one of balance between conviction and caution. On one hand, he seems to believe that the US stock market is too expensive and overly concentrated in a few big names. On the other hand, he sees significant long-term potential in China's leading tech companies due to the large government stimulus and potential for increased consumer demand. So by hedging his China trade with put options, he's protected at least a portion of his assets in the event that he's wrong and there's a further downturn in the Chinese market. Only time will tell whether Burry's bold move will pay off or if the risks outweigh the rewards.